As reported, housing starts fell unexpectedly in June by 1%, as did new building permits. One silver lining, though, single-family home construction rose for the 5th straight month. In another economic news, producer prices also fell in July. So here to tell us what it all means for a recovering economy is Diane Swonk, chief economist at Mesirow Financial, and real estate expert Shari Olefson. And CNBC's Diane Olick joins us as well. Diana, what do you make of today's news?
You know, I'm not all that. Oh, I'm sorry, Diane Olick.
Oh.
Sorry, wrong Diane.
Whichever. I'll take it just for a second. First of all, we did see the unexpected drop in housing starts, but really that was driven by multifamily, which is having all kinds of problems with credit. That is a commercial credit market, and builders unable to get the loans for the large buildings. We did see a bump up of 1.7% in single-family housing starts, so that's an improvement, and we've seen a bump up in permits as well, up 34% from January of this year. So some good news on single-family versus multi. Diane?
Okay. Yeah, I agree 100%. I mean, that's exactly what's happening. There's the condo market's not getting any funding. Commercial real estate, we saw the Fed actually make more announcements about being able to fund commercial mortgage-backed securities out there, extending their programs, their TALF programs. That's because commercial has not been funded in a long time, and there's nothing in the pipeline, so that's going to remain weak. But starting to see something bumping along on the single-family side. A lot of build-to-suit are now starting to come back a little bit. That's individuals actually paying for it. Not much speculative. I don't expect to see much speculative for some time. But the important thing is the shift in momentum. We're at the bottom, not a big bounce up, still a lot of headwinds, but at least
we're not going down further.
Right, and you can only go to zero. I mean, you can't go negative.
Right, exactly. Shari, what is the overall goal here? Like we said, at least we're not going to zero. At least there seems to be some kind of move in a positive direction. But the reality is, as Diane just pointed out, speculators are gone, which is probably a good thing overall. And no one really anticipates that we're going to go back to those heady days of 2006, 2005, when real estate kept appreciating. What would be the new normal?
Right, Trish. Well, you know, I think Diana stated it well a few days ago when she said that we want builders and we want the real estate market to recover in a more healthy way. And I think that these new statistics certainly indicate that builders are hedging their bets by focusing on some of the better performing sectors like single family and avoiding the multifamily for many reasons, not the least of which is the lack of credit availability. But let's remember that behind the new housing starts are three factors. One is the available vacant units. The second is the demand by new households. And the third is the other financial conditions like unemployment and mortgage interest rates. Now, in 2006, housing starts peaked at over 1.5 million units based on builders' perceptions of these things, which, as we see with 2020 hindsight, turned out to be wrong. And they fell by more than 50% after that. So the million-dollar question now is, what's the reality and what's the perception?
Speaking of that, Diana, I mean, didn't you look at a new study that said that 81% of people think that their house is going to be isn't losing value any longer or has hit bottom?
That's a new Zillow survey that's out today, and it just shows how completely, I don't know, disoriented Americans are in the current housing recovery. They think their housing, 81% think that housing is not going to lose value, and they actually believe their home is going to appreciate over the next 6 months, whereas most analysts you talk to believe that home prices will fall another 10 to 15%. Something else I wanted to get into, though, is the concern I have in today's numbers on the housing starts is, are they slightly artificial in the bump up because home builders are trying to get in those last few buyers to take advantage of the first-time home buyer tax credit, which expires November 30th. And what will happen after that? And Diane said that she said there was not a lot of spec homes in these numbers, but what I'm hearing from some folks is that they are building a bunch of spec homes now to try and get these first-time home buyer tax credit people in before the expiration.
Well, Diane, what about that?
You know, I do think the spec home is still very, very small, but we are seeing the speculators. The real competition for this market is the foreclosures. And Diana, you've talked about this before. Affordability has gotten to be so high, even in the most unaffordable markets in California. We're now hearing stories of bidding wars between first-time buyers and speculators going after foreclosed homes that are now 50% off their peaks or even more. And so this is kind of interesting, is it's really tough to justify buying a new home when it's cheaper to buy a home out of foreclosure and fix it up. And so I think this is another headwind that industry is going to have to deal with, and we will see the secondary effects of that as the first-time buyer housing tax credit does wind off. We might even see some extension in that tax credit. I wouldn't be surprised of it because it is one of the only places we've seen strength is the first-time buyer part of the market.
All right, guys.
And even with that segment, we're seeing a differentiation in markets. You know, California seems to be doing a little bit better. Florida, prices are still falling.
Right. Yeah. And in Florida, the key issue there is insurance costs are higher than real estate costs. I mean, you know, it really makes the equation both on employment and the affordability is different when you've got to pay for hurricane insurance or self-insure and you just can't afford it.
We got to leave it there, guys. Thanks so much for joining us.